Hey guys, welcome back to the Real Estate Monopoly. My name is Kerwin. Today's guest, we have a very exciting person here today. His name is Rob Beardsley. Rob Beardsley oversees acquisitions and capital markets for Lone Star Capital and has acquired over $300 million of multifamily real estate. He's evaluated thousands of real estate opportunities, and he uses proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions. Rob, I'm very happy you're here. You have a very impressive track record, and I'm one of my role models. So I appreciate you taking the time to be here today. Before we get into your awesome accomplishments in this industry, can you provide some context into your life before real estate?
Sure. I grew up in Silicon Valley. My parents ran a residential brokerage firm from home. So I grew up in a real estate family, but real estate wasn't really my passion until college. I went to school for computer science and thought I would go into the tech industry, either by way of a startup or consulting. But I got the real estate bug in college, really fell in love with multifamily. I love the idea of long-term wealth and building assets, working for assets, not for money. And that's where I was able to uh, start to learn more, meet my business partner, start Lone Star Capital, join a mentorship program. And from there, ever since then, we've been able to acquire over 300 million in multifamily assets, all in Texas, and launch our property management business. And we're looking to continue to grow.
No, that's awesome. And I believe your parents were in the single family space. I think you said they did some flips and things like that. And an interesting aspect of your story that I really wanted to dive into briefly is that your parents, they were, successful and of course making money, but they weren't necessarily building wealth. And that was a mindset shift you had to make in transitioning into the multifamily space. So can you expand on at what point you determined or identified that maybe your parents weren't really approaching it the way you wanted to?
Yeah, I mean, just seeing them hustle and struggle was not very inspiring, right? It's like, oh, well, real estate doesn't look very fun. And I don't know, I just always naturally had a long-term thinking approach. And I love the idea of delayed gratification and saving and investing. And so when you're doing flips, for example, single family, none of that's really necessarily happening. So that was kind of the paradigm shift from single family to multifamily that resonated with me. So it was almost kind of like a push and a pull.
Yeah, 100%. And in the past, you've mentioned that single family is it's similar in terms of like the difficulty in order to do a multifamily deal. And I really like the response that you gave to this question. But why do you think people don't get into multifamily then if it's relatively the similar amount of work and effort?
Yeah, it would just be a limiting belief. The numbers are bigger, so they're more intimidating. But like you said, at the end of the day, the work is roughly the same. I mean, it's true in the multifamily space as well. When you're buying a 10 unit deal, 100 unit deal, and even if you have a 100 unit deal that is 50 a door versus a 100 unit deal that's 250 a door, right? The size of those deals are radically different, but the work is similar, if not easier for the bigger deal, aside from raising more money.
Yeah, absolutely. And that's something we had to overcome because we did come from a single family background, and we made a transition from flipping and wholesaling, and we identified that we wanted to acquire wealth. And then we realized how long that would take in the single family space. So in a way, it can be harder in the single family space, like you touched on your first deal. I know you had some challenges, and I think we also had some challenges that are quite similar to the ones you faced. If you can just maybe clarify what the stakes were before we get into the actual problems you faced. How much money did you put hard on that deal, and what was the deal like? How did you come across it?
Yeah, if I recall correctly, I think we were somewhere around 300,000 hard, and we came across it through a broker in Houston. It was an off-market deal. We liked the story, and the price worked for us. So we we put it under contract, not knowing all the challenges that were ahead of us as far as putting the debt together, getting a loan guarantor, raising the equity.
Yeah. And something that I've always asked guests in the past is there's two schools of thought in this space. Some people say find a good deal and the money will follow, and then you have to start raising capital before you find a deal. And I've gotten completely different answers from different people. And I know you are on one side now, but can you maybe touch on what you maybe identify as a misconception, expand on why that is a misconception and how you're approaching raising capital differently now?
Yeah, I totally think that find a good deal and the money will come is a huge myth. I don't believe in that at all. And but I also, what you said as far as raising money before the deal, it's not quite raising money before the deal. It's just building the relationships, building the infrastructure, building the network. You don't actually have to get dollars in the bank before the deal necessarily, but you have to have those relationships ready. So I just call it digging the well before you're thirsty, because when you put the deal under contract, it's already too late. It's really hard to build new relationships when you already have the deal, right? That's a different type of money raising mode that is not fun to be in, but it's something that you have to do at some point anyway, and it's a good experience. But as an ordinary course of business, you want the investors coming to you, and you want to be able to have all the things. I mean, obviously this can't be built overnight, but if you have the track record, the marketing, the investor funnel process, so that they can get to know you, trust you more, and invest with you more easily. That's what you need.
No, 100%. I think raising capital is hard enough without the relationships before you get the deal. I can't even imagine how hard it would be, if you have to start building those relationships, because people invest with those they know, like, and trust. And so, that takes time. You touched on the importance of relationships, and we are big advocates for networking and just building long-term relationships. And we believe multifamily is a relationship business, as I've heard you say multiple times. Can you maybe expand on a key relationship that has really helped you in your own business?
Sure. I'd say, I mean, there's just so many, right?
Yeah.
Everything, every aspect of the business is a relationship, but our investors, from the biggest ones to the smallest ones, those are all relationships, and those have been all big factors to our success. And particularly the early investors that entrusted us with their capital and have now been able to see the success and enjoy the rewards from that success. To the brokers, we've always taken broker relationships extremely seriously, and we try to maintain a perfect reputation in the market as far as brokers are concerned, right? Because if brokers think that we're hard to work with, or that we retrade, or that we're just a bad buyer, they are not going to want to bring us deals. So we're very cognizant of that, and making sure that our reputation is great with the brokers as well. And I'd say at this point, we
Yeah.
have good relationships with all the brokers in our target markets, but we do have kind of one, I'd say, relationship that stands out above the others. And I'm not sure how we built that, but we've kind of been there enough and shown our face enough and bought deals back to back, and have been there when the opportunities have arisen. So I think that's the way to do it.
No, yeah, I completely agree. I always say brokers are the gatekeepers to the opportunities in the multifamily space. So they're very important. And also really appreciate what you said about investors, because without them, we really couldn't do apartment syndication. So absolutely. And I do want to kind of pivot into, and I know you're an expert when it comes to underwriting. So I want to dive into some of the details, and really, on some topics in that space. But starting out, can you just explain briefly what underwriting is for maybe somebody who isn't aware, and maybe tailor it towards a multifamily opportunity?
Yeah. Yeah. Underwriting is the financial analysis of an acquisition opportunity. And it could be the acquisition of a company, it could be the acquisition of multifamily real estate, really of anything. So for multifamily, the underwriting that we do every day is, we're evaluating the opportunities that are presented to us, and we're deciding through our underwriting process what is an appropriate price to pay for the asset. And we do that by obviously plugging in the income and expenses, the projected rents, the debt, the future sales price through the exit cap rate. And then also we have to plug all those numbers in with a price and see what return that projects, right? Because at the end of the day, why are we investing? We're investing for a return, and we need a risk adjusted return. So we need to make sure that we understand the risks of the deal, and then that the return that we're projecting it meets our requirements. And if they don't, then we just simply lower the price and adjust the setup of the deal until that return meets our requirements. And then that's the price that we negotiate and bid.
Yeah, no, absolutely. And I do know that kind of when you're starting out in the space, there underwriting can seem very daunting. And so I know you wrote a whole book on this topic, but if you could provide some really quick kind of tips or rules of thumb when it comes to underwriting, maybe that you would give to a beginning underwriter or a passive investor who isn't really familiar with underwriting.
Yeah, when you're not familiar, I think you need to become familiar. So you
Yeah.
need to get the reps. Nothing can replace getting the reps. So if it's something that you really want to understand and integrate into your strategy, you need to get your first 100 deals underwritten as quickly as possible. And that will start to build your intuition, because after 100 deals, if you truly underwrite them well, you'll start to see the patterns and you'll see, oh, well, I've seen this movie before, right? This deal looks like this, and it's probably going to shape up like this. And that intuition is really helpful, because then you don't have to spend hours on every single deal, right? You have the intuition to be able to look at a deal quickly and go, that's not for me. So I think that's nothing can replace that experience.
Yeah, no, I think that's great advice. And my brother, he's the acquisitions guy, and he's underwritten a ton of deals, and it took us a long time to find our own deal, but I'm sure he would agree with that. And in the past, actually, we've come across deals where the financials weren't really clear or organized the way we're used to, and maybe there's some items that were unclear. How would you approach that, and how have you approached that in the past when maybe the financials aren't structured the way that you're used to seeing them?
Yeah, I actually get excited when I see that, because that means there could be an opportunity here. If the financials are pretty and the property is well managed and the accounting at the property is really, really good, that means the property is probably running well. And those financials are clear to everybody else in the market. So all the other buyers, have the same numbers, and there's not really a competitive advantage. But if you have messy numbers that don't make sense, and you're the one willing to put in more work than other buyers to kind of dig through and figure it out and see the potential value, that can be a way to actually find a good deal. And we've actually done that. I mean, we've we bought deals that had really kind of funky, weird financials, but just through digging in, I mean, I think to answer your question, really asking questions to understand is is what you need to do. And at the end of the day, the in-place numbers aren't terribly important, because you need to model based off of pro forma and the way that you're going to operate the property. So the current owner's expenses, not that relevant. Obviously, you want to look at them and understand what's going on, but you're going to project your expenses based on your ability to operate and your expense comps. And then on the revenue side, it's all about rent comps and being able to find what the appropriate rents are in the market based on the business plan and what you're going to do to the asset.
Yeah, absolutely. And a big part of that business plan is understanding what the property will run at and how expensive it'll be to run. And I'd love to know maybe how you determine how much the property will take to run in terms of expenses.
Well, we just use our historical data across our portfolio and across all the assets that we've underwritten. So, underwriting and asset management is somewhat of a two-way process or a reflexive process, where the knowledge that we gain from underwriting can apply to asset management and vice versa. So as we're managing our properties and we're noticing trends, we can apply those trends to our underwriting. So that way we're making sure that we're as accurate as possible. And on the acquisition side, if we have the benefit of looking at 500 P&Ls in a year, maybe we can learn a thing or two and apply that to the asset management side.
Yeah, no, that's a great answer. I appreciate that. And so you and I, we met in MFIN. It was an event in Charlotte, and I got the chance to see you speak, and you spoke on a great presentation. A big theme or almost recurring topic that I kept having was bridge loans and getting that kind of debt. I would love it if you could, and I heard you mention past the importance of having contingency plans when it comes to having that short-term debt. Can you maybe expand on why bridge debt might not be the best option right now, or maybe what your opinion is on it? And then if somebody chooses to get it, what contingency plans they might want to have in place?
Yeah, so the bridge loan space has changed dramatically in the last 6 months. We did a lot of conventional bridge loans in the last couple of years, But that market, the typical CRE CLO bridge market has dried up, and for various reasons. I mean, the economy is in a weird place right now, and there's a lot of uncertainty with interest rates, and so that causes their ability to make loans very difficult. So the pricing is really expensive. So back 6 months ago, as recently as 6 months ago, bridge loans were very cheap, and you could borrow at bridge loan rates, which were very close to permanent debt rates, almost at times even less, which is incredible, right? You could get more leverage, more flexibility, and it costed you less. So it's like, why not? Why not just take the bridge loan as long as your numbers made sense and you had the reserves to be able to manage any downside? But today, with bridge loans being so expensive, now it doesn't make as much sense to take on that additional leverage. So what we've done is we're doing pretty much all bank debt recently. So that's around 65% leverage. So that's really, for us at least, that's really low leverage compared to what we were doing before. And I think it's a very prudent thing to do. And by being at that lower leverage point, it really greatly expands our universe of loan options and lenders. So, and also, of course, being low leverage reduces your risk tremendously, because if you're going in at 65% leverage, and let's say your loan matures in 3 to 5 years, being able to refinance out of that existing loan or just to sell and pay off the loan is much easier than if you were to go in at max leverage at 80%. So that is kind of what we think is the sweet spot in the market. Because if you look at the agency side of things, for those that aren't familiar with agency debt, that's debt backed by Fannie Mae and Freddie Mac, which is kind of like the gold standard debt in multifamily. Fannie Mae and Freddie Mac have been doing very little business in 2022 because their rates are quite high and their requirements are very strict. So they're not able to really provide much leverage in today's environment. And that is causing people, that's what caused people even before all these recent interest rate changes to go into the bridge loan space. So we're really hoping that the agency market comes back in a big way, because that debt is really great. It's conservative, it's long-term. So we'd love to see that come back, but they need to lower their rates and change some things if they're going to be successful.
Yeah, no, it's very clear that risk mitigation is a core principle of your investment philosophy. And you also mentioned that you're in the Houston market. I would love to know, you keep touching on the importance of like really being local to the market and understanding like the back of your hand. Can you maybe emphasize how that's helped you with mitigating risk and just by knowing the Houston market so well?
Yeah, I would say it's really not that difficult, right? If you just spend a little bit of time, underwrite a couple hundred deals, right? It's not that much work, just underwrite a few hundred deals. You really start to understand the market, right? Because if you're new to a market and a broker shows you a deal in the bad part of town, you don't necessarily know it's the bad part of town. You might be able to look up the income demographics and see, well, it's not the best part of town, but you don't know the stigmas or the history. So just spending some time in the market, talking to the brokers is huge. And also just to have the brokers know who you are in itself is a success and a huge advantage, because there's people trying to enter markets every day and they're just a new person talking to the broker, and that's a very difficult position to be in. So the faster that you can get out of that place, the better. And that's why I recommend people to pick a market and stick to it rather than chase the shiny object. Well, this year's market is this hot market, and then I think next market is over here, right? Because even if that market that you're chasing is the hottest market, if you have to start from scratch, you're better off honestly going to a worse market where you can really be known. You'll be more successful. So that focus has led to us getting better deal flow, first looks, last looks, inside looks, off market, all that kind of stuff. And then also, like you mentioned, just having the expertise as well to actually know what we're looking at.
Yeah, no, I mean, we've done that. We've implemented that into our own business where we focus with brokers and on particular markets, and we've gotten a lot more traction. as a result of that. So that's awesome advice. And when it comes to determining what market you want to invest in, I know understanding future growth potential is important. And I know you are an expert in this. I'd love to know what are some future growth determinants that you should look for in a particular market.
Ideally, population growth above the national average. Historical rent growth is good. I also like to look at income relative to rent and to see that there's an affordability component there. For example, I'm not trying to say that Miami or New York are bad markets, but people in those markets spend roughly half their income on rent, right? That's a pretty firm ceiling, right? Basically, the only way that rents can grow is if income grows in those markets. But if you look at places like Albuquerque, which has one of the lowest percents of income going towards rent, you have headroom in rent by way of that percentage going up as well as income going up. So I do like that affordability component, especially as a defensive strategy. When you have, let's say, a recession, people are going to flock to those low cost cities. So Houston is a low cost city, which we like a lot.
Yeah, and you touched on a really important point I want to expand on. The percentage of income going towards rent. Is there a certain ideal kind of like percentage you look for? And when you find that, how much are you willing to push it up? And realistically, can you expect to push it up?
Yeah, I mean, 25% is good. And, up to 30% is acceptable.
Yeah. No, this all seems like it's a very important when you're looking at underwriting and looking to be conservative, not only for your own underwriting, but if you're analyzing the underwriting of another sponsor as a passive investor. And I know, like I said, you could write a whole book on this topic, but if you could provide some general rules of thumbs for a passive investor who's looking to kind of analyze and review someone else's underwriting, how can they tell if someone's being conservative?
It's tough. It is very tough, especially when you are pulling up a model that is not yours and you're not familiar with. There's a bit of a learning curve there. So one way to go is to actually take their numbers and put it into a different model that you are familiar with. Most passive investors would never do this, right? It's a lot of work, and they're not looking for a new side hustle type thing. So that's if you had a passive investor that was full time and willing to put in the effort, what they would do is they would use one model consistently. They would know how to underwrite. They would take the sponsor's numbers. They would take them and it's just step one, plug them into their model and just see what happens. And then from there, they can tweak some assumptions. Maybe if they disagree with the pro forma rents, or they disagree with some expenses or the growth assumptions. And finally, the exit cap rate, right? Those are kind of the big hitters that you want to sensitize or evaluate as kind of a sanity check as a passive investor. So it's not easy to do, though. It sounds easy, but it's not easy because rent comps are not straightforward, right? I can pick a property that's a bit further down the street or in a slightly better area, and that's going to have higher rents, and you may not exactly want to comp to those rents. So it really requires a little bit more nuance. But I think if you look at the totality of it, you can kind of get a sense whether, everything is generally conservative or kind of generally pushing on the margins everywhere.
Yeah, no, that's a great gold nugget, and I really appreciate that. You didn't mention stabilization assumptions, but I would love it if you can maybe dive into that a little bit. What are some red flags that somebody might look out for, or even in your own underwriting? What you want to be cautious with when it comes to those assumptions?
Yeah, the two big things when it comes to stabilization are the time and the occupancy that you maintain through that time. So, right, if your goal is right, obviously it's unrealistic to hit your target rents in the first year. It's going to take some time, unless maybe you want to reduce your occupancy down to 50%, renovate, release back up. Then maybe in a year, if you move fast, you can actually accomplish that. But if your goal is to maintain 95% occupancy, then it's going to take you some time to get through all the units, depending on turnover rate.
Mhm.
So those two factors are the things you want to play with. And so for us, based on kind of what I'm seeing as far as the deals that we have been buying lately, we've been buying more stabilized property that's fairly well performing for the most part. Some deals have not been. And when they're well performing, right, they're at 95% occupancy, 97% occupancy. I think we're buying a deal right now that's 98% occupancy. So, I mean, the market's doing really well. But when a deal is 98% occupied, how are you going to renovate all the units, right? There's just no availability. So for us, I would say typically our assumptions there are we'll never assume more than 95% occupancy on a stabilization period time or on just a terminal basis, right? Throughout the whole investment. So 95% occupancy. And then typically we're projecting a 24-month period to implement the business plan.
Oh, that's awesome. And I've heard you mention like when you have a way to stress test your own underwriting, and when you kind of go to the full extent of that test, I believe most deals don't pass that test. But I would love it if you could maybe expand on how you're approaching that stress test when it comes to your underwriting, and how it maybe isn't set in stone and you can kind of be flexible with it in a way.
Yeah. So this is the exit test is what it's called. And basically it stresses the deal's ability to pay off the existing loan. And we kind of touched on this earlier, but there's many factors at play. And well, let me back up and say, why is this so important, right? Because if you have an existing piece of debt on your property and you can't pay it off when it's due, that's a problem, right? Then the lender might force you to sell the asset in order to be able to pay off the loan, and then you're taking a loss on your equity, which we don't want to do.
Yeah.
And what we want to do in a downside scenario is be able to refi that existing loan out and put a new loan on, so that way we're not forced to sell in a downside scenario, right? Because if we're not forced to sell and we can live to fight another day, we can wait until the market is strong again and we can capitalize on a sale in the future. So that's really the purpose of the exit test. And from a lender's perspective, lenders run exit tests as well because they want to know that they can get paid off, right? A lender at the end of the day doesn't really want to be stuck in a deal and stuck taking over your asset. So with the exit test, the factors at play are the going in leverage, amortization if there is any, because amortizing the loan down during the hold period reduces the loan amount, which makes it easier to pay off. But if you just go in at lower leverage, then it makes it easier to pay off to begin with, right? Like I mentioned today, we're going in at 65%. That's easier to pay off than 80%. How much value you're creating also has a big factor in being able to pay off the loan, right? Because if you double the property's value, now you can get a loan, even if it's low leverage, even if it's 60% leverage, you'll be able to pay off the existing debt because you've just created so much value that you can actually then use for the new debt.
Mm-hmm.
So those are some of the factors at play. And then we stress test that through raising interest rates, raising cap rates, reducing income.
Yeah, no, that's awesome. And I know a lot of these kind of precautionary steps people take and you take are to not necessarily predict where we're going to be in the market cycle, but prepare for a downturn if it is to come. And you had a really interesting YouTube video that you did where you discussed how there isn't really a point in trying to guess where we're going to be because no one really knows. And so instead of changing your underwriting, you might want to adjust your strategy. I would love it if you could maybe briefly touch on that and how that's manifesting itself in your own business.
Yeah, I like this topic a lot. Right, because I don't think it's necessarily the right thing to do and go, look at the market and say, well, I think this, so I'm just going to bake that into my numbers, because it's just very hard to predict the market. Instead, if you have a sense of where we are, which I think having a sense is not as hard, you can have a sense that, hey, prices are high, cap rates are low, things are being a bit aggressive, there's a lot of bidders, right? You can tell when the market's hotter or colder. So if the market is hotter, your strategy may want to change. You may want to understand that, a lot of things, for example, I'm hearing is the price difference between a B and a C asset, or even an A and a B asset. There's still definitely a price difference there, more so than B and C. If that price difference shrinks, then why not buy the higher quality asset and take less risk? So it's shifting your strategy like that. If something that we saw happen over the last 2-3 years is tertiary market prices went crazy, and well, all prices went crazy, but tertiary markets appreciated, I think, in some cases faster than primary markets. So what did that do? That again shrunk the price difference between primary markets and tertiary markets. So even if you could get a little bit better price and a little bit higher return in tertiary markets, it probably makes sense to shift your strategy to the primary market and be defensive and take less risk. So that's shifting the strategy. So again, I didn't talk about changing how I'm underwriting. I'm just changing the strategy.
Yeah, no, that's so important. And I think that's really awesome that you shared that just then. I did want to know, so this is the last question before our speed round. Before you got into real estate in terms of multifamily, like I'm sure you just didn't know everything, and you're in a much different position today. Is there something that you're doing differently today, or how have you, I guess, transformed since those first few trials in multifamily?
Yeah, I mean, we're learning every day. We're making mistakes every day. I think I could think about some big changes from earlier on, but just right now in my mind, just this shift that's happening in the market and how it's essentially forced our hand into doing lower leverage debt. In a way, I'm thankful for it, because I would have not really had the need to or desire to shift our debt strategy. But I think lower leverage is really a great way to go, particularly today. So I think, will there be another time where we might do 80% leverage debt? I think there could be. I think the market may shift from being hot to cold, and then all of a sudden, wow, it makes sense to take risk. Go buy that bad Class C deal in the tertiary market with 80% leverage debt, right?
Yeah.
Like right now, the thought of that is like, oh my gosh, risk, 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 terrible idea. But when the market turns, that could be your opportunity to then take as much risk as possible, because you'll get paid for it. So the thing I love about this business is it's always changing. So the things I thought before, maybe not appropriate today, and then again, it'll change again. So my understandings grow. And, thinking about fixed versus floating rate debt, for example, I've been a big proponent of floating rate debt, and I still am. I think locking yourself into yield maintenance, people really underestimate the negative uh, externalities, or just negatives about that.
Yeah.
But right now we're experiencing this rising rate environment, and it is really hard to sit here and say, yeah, floating rate debt is great, right? It's really hard to do that. It'd be really great if we had locked in some fixed rates in the 3% range, a year ago, and not be dealing with this right now. So it's always changing, and it's a challenge.
Yeah, that's funny you say that, because a lot of the education we had at the beginning, it seems like it's almost outdated at this point, because it was written and created during a time when we were much different times. So
Yeah,
it's
yeah,
exciting. You get to stay on your toes. But it is time for our speed round. Rob, are you ready?
I'm ready.
Awesome. All right. Well, first question. I'd love to know, what is your long-term vision for your business, and what are you hoping to accomplish moving forward?
Yeah. So in 2021, we did about 100 million in acquisitions. In 2022, our goal is 250 million, and we're on pace for that. And I think 2023 may present a slowdown for us. I'm not sure, but the goal was to do 500 million. But who knows? We can't force it if the market's not there for it. But basically, the goals are just to continue to grow acquisition volume and really scale up the business to where it's running like a well-oiled machine. And I would love to see us being able to buy $1 billion per year in deals. That would be huge. And because I think, once you're buying $1 billion per year, it's only a matter of time before you're scaling up to having, $10 billion in real estate.
Yeah, those are some really awesome, lofty goals. I definitely, definitely can understand that and relate to that. And I'd love to know, I mean, what is your why that drives you to kind of aim so high?
That's a good question. And I can't really use the answer money, because you don't need that much money.
Yeah.
So it's not, it's kind of just the competitive spirit of wanting to build something. I've always been a builder. I really enjoy struggling towards something, and the satisfaction that putting effort into something and seeing the results yeah, I've always really been a big fan of that. So I think that's my why.
Yeah, no, I love that. My brothers and I, we actually have, so we always tell people we're working, and now we say we're building because this isn't work. Like I chose this is my path I chose. So we're building every day, not working. Um,
Nice.
yeah, no, if there was, you dropped a ton of gold gems and a ton of wisdom today, but if there was one piece of advice you'd want someone to walk away with from this episode, what would that be?
I would say, I mean, we talked a lot about change, and I think change is good. And being uncomfortable, being comfortable with being uncomfortable is really valuable and something necessary if you want to, change for the better.
Yeah, it's great advice. Thank you. And Rob, if anyone wants to learn more about you or just follow you on your journey, where can they go to do that?
Yeah, you can learn more about us at our website, lscre.com. That stands for Lone Star Capital Real Estate. So that's lscre.com. On our website, you can download our underwriting model for free. We've got a new passive investor guide that's available to download for free. There's some other links to content and resources that we put out. And also I post daily on LinkedIn. So feel free to connect with me there as well.
Yeah, and can you also, I don't know if you mentioned it, but can you expand on what the title of your book is?
Yeah. Yeah. So my book is The Definitive Guide to Underwriting Multifamily Acquisitions. It's a real easy read, but really powerful. It's a straightforward step-by-step how-to guide on underwriting, whether it's your first deal or your 100th deal. I think there's a lot of value there.
Awesome. Well, thanks so much for your time, Rob. It was a pleasure chatting with you. And thanks for everyone for tuning into the Real Estate Monopoly with the Adonis Brothers. Please make sure you leave a 5-star review and a comment if you got any value, and share with a friend. And please get out there and take action.